Hey guys, welcome back to the video. Today we're going to be discussing general partnerships. So in a previous video I made, we discussed sole proprietorships as a business structure that owners can use. That focused on businesses with just one owner. Now we're going to start moving on and thinking about partnerships. So partnerships are businesses with more than one owner. So there are three types. You've got general partnerships, limited partnerships, and limited liability partnerships. Today we're going to focus on the most common form of partnership, which is the general partnership. So yeah, let's get into it. Okay, so let's start with a simple definition of a general partnership. So a general partnership is a business that is owned by two or more partners. So this is the key point, right? Is two or more owners, whereas in a sole proprietorship, you could only have maximum one owner. So any more than two owners makes it a partnership, and these partners are known as the GPs or the general partners. And they're all involved in the day-to-day operations of the business. They all kind of contribute to the sort of successful running of the enterprise. They contribute some form of skill or sort of level of acumen in an area of the business, which kind of helps it kind of move forward and run effectively. And the structure allows the partners to share in the profits of the business. So yeah, they all kind of have an ownership stake in the business, and then they share in the profits sort of relative to their percentage ownership, but they all have unlimited liability. So I'll touch upon what unlimited liability is in a bit, but that's one of the key downsides of the structure. If the business is to fail, they're on the hook. All the partners are on the hook in terms of their personal assets may have to be forfeited to fund any debts or losses that the partnership has created. So yeah, their sort of personal liability is unlimited if the business is to sort of struggle and fail. So they're the most common type of partnership structure, like I said in the intro. They have very similar features to sole traders and sole proprietorships. So yeah, they have the unlimited liability component. They're taxed in a similar way. They have similar limitations. We'll run through this all in a moment. But the main difference between a general partnership and a sole proprietorship is that a partnership allows for a lot more capital to be added, and that's because a partnership is able to bring in additional partners. So if the business is struggling to grow and is struggling to access capital, a partnership is able to bring in more owners. It can bring in more equity capital by adding additional partners and bringing more owners, which a sole proprietorship just cannot do. By definition, it can only have one owner. So there's a limit to how much equity capital a sole proprietorship can raise through adding more owners. It's extremely limited, whereas in a general partnership, you can just keep on adding partners in theory if you want to sort of keep on injecting capital. And being part of a partnership is good because you can bring in different individuals who have sort of different and complementary expertise to yourself. So you could have three partners in a business, all who've got different sort of skill sets and expertise, and they complement each other. One person is not going to know everything. So having sort of multiple partners within the business can bring in sort of complementary skills and expertise to help sort of create a more well-rounded business. And again, the sort of incremental capital that additional partners can bring in too is obviously a benefit too. So the partners share in the risk and return profile of the business based on their respective ownership percentages. So yeah, the more you own in a partnership, the greater exposure you have to the profits, but also the losses if the business is to struggle. So you basically, the way the partnership works is it generates revenue, it generates profit, and then depending on your the partner's ownership stake in the partnership, they will take home that proportion of the profit. So if a partner owns 50% of the partnership and the other two own 25%, then the first partner would take home 50% of the profits in 1 year, and then the other two partners would take home 25% each. So yeah, your exposure to the risk and reward of the business is a function of how much you own. So yeah, it's a function of your respective ownership in the business. And yeah, all profits, losses and risks associated with operating the partnership are shared amongst the partner group. So there's a pooling of risk, a pooling of potential. All the profits and losses are pooled based on the sort of relative ownership of the partners. And they're good because they're highly flexible. So they don't require any form of written partnership agreement. You can have a written partnership agreement in place, but you don't have to. The roles and responsibilities can be divided out and allocated amongst the partners based on a verbal agreement. And yeah, how profits are shared. Again, it can all be verbal. I mean, it would probably be highly recommended if you're going into business with someone that you write it down, but it can be verbal if that's what one wants. General partnerships can be formed verbally or just through actions. So there's no need for any form of written agreement to be in place. It can all be done verbally. It involves a small number of partners who contribute often equal amounts, but sometimes different amounts. If you have 3 partners, it could be a 33%, 33%, 33% split, or it could be a 40%, 30%, 30% split, or whatever. Typically, it's sort of even Stevens, but it can be sort of equal or different amounts depending on the nature of the partnership agreement. One partner may be bringing more capital or more expertise. There's flexibility there. And they bring complementary business expertise and acumen. So one partner may bring, business development expertise and may have really great relationships with clients and customers. Another one may be the finance guy. So they may bring sort of great financial acumen that they can sort of bring to sort of bring the business forward, and another maybe sort of more operational back office, sort of legal compliance type expertise. So that's the great thing about partnership. You can pool skill sets, and then they share in the day-to-day responsibilities of running the business. And like sole traders, the taxation structure is very similar for a general partnership. The business follows a pass-through taxation structure. And that means there's no corporate income taxes due. The business itself is not taxed. So business profits are not subject to any form of corporation tax or corporate income tax. Instead, what happens is the profits are passed on directly to the partners, and then the partners have to pay personal income tax on their share of the business's profits. So the business generates profits, pays no tax, passes on those profits to the partners based on their relative ownership share in the business, and then those partners have to pay tax on those profits based on their personal income tax rates. So that's how the taxation structure works. Hopefully that makes sense. So that's very similar to how sole traders work, except in sole traders there's just one owner. So one owner takes the profits. And then similarly to a sole proprietorship, the downside of the structure is that the potential for business growth is limited by the ability to source new financing. So, how many new partners can you really bring in? To add additional capital. There's sort of an upper limit to that. There's only so many new partners you can bring in without diluting ownership too much, or kind of it just not being necessary to bring in any more partners. The owners are limited by how much equity financing they can bring in by adding new partners, and also by the borrowing capacity of each partner. So you've basically got 2 sources of financing: equity capital from new partners, but also the borrowing capacity, the personal sort of borrowing capacity of each partner. And there's a limit to that, right? There's an upper limit to how much each individual partner can borrow from a bank. Typically, it's not that high a limit. Another downside, if one partner fails to meet their share of a debt payment, all partners become collectively liable for that outstanding debt payment. So basically the message is, be careful who you go into business with, because if you've got one partner who does a dodgy deal or takes on a debt and you don't know about it, and then they fail to make their part of the debt payment, or just one of the business's debts, they fail to pay their share, then all the partners become collectively liable for that outstanding payment. So you could lose your house if you may be paying your fair share of the debt, but if your partner is unable to fund their share, then all the partners become liable. All the partners can lose their home, lose their car. So yeah, be careful who you go into business with, because the poor business decisions of your other partners could end up putting you on the hook financially for their, and you may have to forfeit your personal assets as a result. So yeah, be very careful who you go into business with if you're considering a partnership. All the partners have unlimited liability. That's the key word here. That's the key word that curriculum likes to use for sole traders, for general partnerships. That the owners have unlimited liability for the business's losses and debts. And finally, the collective risk tolerance of the partners can also be a limiting factor. If the partners are risk averse, they may sort of turn down attractive investment and growth opportunities that could help scale the business and sort of push it into sort of into new areas, and help the growth trajectory of the business going forward, because they perceive it to be too high risk. So yeah, the risk tolerance of the partners is one factor that can hold the business back. Okay, so yeah, let's just do a quick sketch to make sure we're clear on how this structure works, right? So let's say we've got a general partnership with 3 partners. So we've got partner 1, partner 2, and then we've got the business, so the general partnership. So this is the business structure that they've formed together. They come together, 3 partners, and they formed a general partnership. And let's say each partner owns 33%. So it's an even split of ownership. So what does this mean? What do the partners, what actually happens, right? So the partners contribute capital, equity capital to the business, and in exchange, they're subject to unlimited liability on the business's losses. In exchange for shared control and ownership. So yeah, the partners contribute capital either equally or in differing proportions, and then they hold personal liability, unlimited liability for the business's losses, but in exchange for all that, they have shared control and ownership over the direction of the business. And yeah, the ownership split can be even or it can be uneven. Really depends on the agreement between the partners and what they're all contributing to the business in terms of capital, expertise, etc. And then just finally, general partnerships can include service businesses such as builders, contractors, and JVs. So yeah, there's a few types of general partnerships there, just to give you a bit of a flavour. You may be asked what kind of typical businesses would structure as a general partnership. So yeah, that's worthwhile knowing. So yeah, that's everything I had to say on general partnerships. There's a lot there, but hopefully that was all kind of helpful as an overview as to the different features of a general partnership, what the pros and cons are, why owners may consider going into a partnership with one another, what the potential pitfalls may be. So the key concepts are unlimited liability being shared between the partners. That's really important. The different expertise and complementary expertise and skill sets different partners can bring to the table. That's really important to understand. Taxation, so the pass-through taxation structure that we saw at sole proprietorships, that's back again and relevant for general partnerships. So yeah, that's kind of all I had. Any questions, please feel free to fire off in the comments, and I'll see you guys in the next video.